Good morning and welcome to Fridays with Vistage and our 2017 Economic and Financial Market Outlook. My name is Bill Black. I'm a Vistage member and founder and host of ExitCoachRadio.com. Today's webinar is about success in investing, and success in investing requires discipline, a long-range perspective, and a contrarian perspective. To gain insights into how investor behavior correlates to market challenges and opportunities, Jeff Mortimer, Director of Investment Strategy for BNY Mellon Wealth Management, will share his considerable perspectives. Jeff's clear-eyed research, assembled over multiple years and across all market cycles, shows that investor behavior and market and economic fundamentals follow a remarkable, repeatable pattern, and understanding this pattern can prove invaluable as you strategize about what might lie ahead. You'll find Jeff's perspectives both highly informative as well as relevant to your own situation. Jeffrey Mortimer is the Director of Investment Strategy for BNY Mellon Wealth Management. He leads a team that sets capital market expectations and is responsible for making asset allocation recommendations. Jeff has more than 25 years of experience in the financial services industry. Jeff is a national speaker on issues of investment strategy, the financial markets, and the economy. He's been featured in numerous media outlets, including Barron's, Fortune, Bloomberg, and CNBC. Jeff serves on the advisory board for the Stephen D. Cutler Center for Investments and Finance at Babson College. Ladies and gentlemen, Jeff Mortimer.
Bill, thank you very much. It's a pleasure to be here and speak to Vistage membership. Let me get started without further ado. Certainly, I have a TV on in my office, and we are approaching Dow 20,000, a wonderful milestone. Not that it means much to people that are in the business, but certainly is a wonderful milestone. I can remember back Dow 10,000, and it's just nice to see markets reacting so positively over the recent couple-month period. But with that said, let's put that in perspective. Is it a time at Dow 20,000? Is that a time to sell all your assets and move to cash, or are we just sort of getting started here? So I hope to answer after this 30-minute or so presentation. I hope to have that answer for you, not just with an opinion, but by showing you giving you some historical perspective on kind of how markets move through time and where we might be in the cycle sort of this time around. So with that, I'm going to move to my first slide, and we're going to talk about market performance. Again, these are in the public markets. I understand a lot of you are business owners, but we can still learn a lot from the public markets. So let's take a look at what they have been telling us, and I'll try to make it pertinent, or I will make it pertinent to you and your individual businesses as well. But since the election, the year-to-date return up through the election is in the blue. And then return since election is the middle bar or the gray bars. And then the total year-to-date or the total 2016 return is actually the purple bar at the end. This is by each asset class. You can clearly see that since the election, small caps have really dominated. Small caps are typically defined in this as $2.5 billion market cap or below. So still fairly large companies from a Vistage point of view, but still relatively small in a total capital markets. And so small companies really benefited. A lot of that, our belief, is because of some of the Trump, perhaps not only his tax policies, which could benefit small companies, but also his belief perhaps of a greater protectionism taking place. And small cap companies are much more domestically focused, and I think is one of the reasons why you've had such a very broad rally in small caps since election day. You can see emerging markets, again, a very good long-term asset class in our view, if you look out 7 to 10 years, but really have struggled mightily since Trump was elected. And a lot of this, again, is because of currency issues, so a stronger dollar. Those of you that have companies that are affected by currency, the dollar is certainly strengthened, especially against the peso and other emerging market economies. And so you're seeing a lot of them who have a lot of debt. Many of them have debt in U.S. dollars, and they have struggled, of course, since the election transpired. You can see bonds. Those of you that own fixed income or in the bond market, rates have risen. Bonds move in the opposite direction. So although they enjoyed a very good market up to the election day, up 4.9, they have since struggled. And then hedge funds and other diversifiers in the portfolio have done decently well, but certainly lagged behind their long-only brethren, both in large cap and small cap domestically. You can also see what a year it was to be invested in the U.S. as opposed to international markets. You can see how much higher those kind of returns have been. And we think that, again, will continue to take place in 2017, but I'll get into that later. But I think this is just a good summary of 2016 in general, really broken down, pre- and post-election day and some of the changes that have taken place since Trump was elected. Our major themes to 2017, there are 6 of them, some of them repeated from 2016 and some are new. Let me just take them in turn. Again, broad economic themes that we think take place. The center of the page is most important. We think economic growth continues. We think a bit higher than it was in 2016, but perhaps a lot of the Trump policies, especially regarding infrastructure, really don't start to shine even up until 2018. Infrastructure tends to have a 12-month lag to it, so we'll have to see what he gets through Congress and how quickly, again, shovel-ready and all those types of projects that may come to fruition might have a lot more influence in 2018 than they do in 2017. A tax policy or reduction in taxes is a lot quicker to have impact on GDP growth. So those of you that are looking for individual or corporate tax reduction, if that does come, especially if it is retroactive onto January 1st of 2017, would have a much more immediate impact on GDP growth because it might have a greater impact on revenues and spending and those types of things instantly. So look for that to have a greater impact. But let's see, Trump's 100 days, sort of where he attacks first. Again, now knowing that the tax policy has a much sort of quicker trigger than infrastructure might. So that's really the shift from fiscal reform away from monetary policy. We expect the Federal Reserve will continue on its sort of rate hiking plan. We think in the cards for 2017 are another 2 to 3 rate hikes, which will take the Fed funds rate up from where it is today up to either 1% or 1.25%. Certainly extremely low by historical standards, but certainly moving in the tightening direction. And that's why, again, moderately rising interest rates, not only on the short end of the curve, but also out the curve. We think that the 3-year continues to move modestly higher, but that the yield curve stays substantially steep. Those of you that study economics know that a steep yield curve, a yield on a 10-year being much greater than a yield on, say, a 3-month or a 2-year, that is a precursor for economic strength. And the worst thing that you can see from a yield curve, meaning a 3-month T-bill, is the same yield as a 10-month or a 10-year bond. A flat yield curve has been a precursor for economic slowdown or economic recession. So please take away from this that the slope of the yield curve is extremely important as well, and something you can check in any Wall Street Journal or anything online. A strong dollar, we think, continues for the year. Those of you that heard me mention, again, the impact on large cap and emerging markets, those types of things, a strong dollar we don't think is going away. We think a lot of the move is over. The dollar won't continue to strengthen, but will remain strong, we think, throughout 2017. Disinflation back to reflation, another one of our major themes. The last few years have been disinflationary. This is still having inflation, but at a slower pace. We think now that sort of moves around and that inflation now has an impact on asset class returns, bond returns, and even equity returns in 2017. We still think that the move to reflation is modest, so that this is a process more than a sort of a pivot point that will take place. But again, we'll have to watch inflation very closely. Inflation has an amazing impact on asset class returns. That is, of course, my job, is to look out 12 to 18 months and see what asset classes will be doing. And I know it must affect each of your businesses, of course, perhaps differently, but higher input costs are potential, higher wages, all those types of things happen when inflation starts to become, when it starts to enter the equation, when that variable enters the equation once again. Modest equity gains, we think, are in the cards for 2017. I'll get into a little bit of that more later. And finally, bouts of volatility. We think that 2017 will be marked by, it was more persistent in 2016. You had things like the Brexit, the election. You had a lot of other issues that took place in 16, which we think, of course, go away. Some of those headwinds go away. But we think bouts of volatility, perhaps shorter term, a Trump tweet, a Trump policy, an argument in Congress, a geopolitical issue, a terrorist attack. We think they're more sort of shorter term bouts of volatility throughout 17. But I think, as I'll show you later, that buying into that weakness, you'll probably be very well served, those of you that have money in the capital markets or those of you that have opportunities in your businesses to take advantage of price weakness. I would advise you to do so. Let me turn to the next page and really get to a framework that I've developed through the years. This is a page which is, my joke about this is that if you cut my head open, this page would fall out. It is the way that I look at the world. It is the way that I make sense of a lot of variables that I am given on a daily basis and then have to turn those into recommendations. Those of you that are business owners understand that we live in an uncertain world. The future is unknown. So I've always thought then you need to have a lot of rigor underneath you in order to make decisions in an unknown environment, and that you need to have a decision-making process that is known in advance, because in the heat of battle, it can be very difficult to make the proper decision when you only have a few minutes to do so. And so this framework has really helped me, enabled me to make good decisions when I'm presented with either opportunities or threats or whatever the case may be, because I am grounded to this page. I did create this page some 14 years ago. Nothing has changed on this page. Like anything, if you put your life on a page, it should stand the test of time, and knock on wood, this one has so far. It is, of course, looking at the public markets, and as business owners, you might be saying, well, what does that have to do with me? I promise that I will tie it into your worlds and allow you to hopefully leave this call even making better business decisions, as well as if you have any free money that you've invested in capital markets, to make good decisions with that money that's invested in the public markets as well. So with that, why don't I start, and we'll decipher this page sort of into parts. So it is an economic trough is at the bottom of the page. Expansion is up the left-hand side. The top of the page is an economic peak, and the right-hand side of the page is an economic contraction or recession, depending on its severity. So I want to start with the macroeconomic indicators, or the words that are on the outside, the outermost circle. At the bottom of the page, you'll see the words high unemployment. This is an indicator that I think is most important for looking at and deciphering market bottoms and economic bottoms. The unemployment rate will change direction at market lows. In other words, let me give you an example. The unemployment rate was about 10% in 2009, 2010, and then went to 9.8, 9.7, 9.6, 9.5, and today, we just got the report today, sitting down in the mid-4s, 4.6, 4.7% unemployment. So clearly, unemployment has moved from high, which is a sign of a market trough or an economic trough, and has moved to a much lower state. So you need to understand, as business owners, the best way to see the direction of our economy is look at the trend of the unemployment rate. It is a lagging indicator. It will not tell you exact tops or exact bottoms, but it is incredibly accurate in telling you which direction the economy is moving. And the shorthand answer is that the economy and the stock market both move in the opposite direction of the trend of the unemployment rate. The trend of the unemployment rate has gone from 10% to 4.6, clearly a downward sloping line, and we could all agree, I think, that the economy and the stock market have moved up since 2009 and 2010. So again, this indicator is working its magic very well. A lot of people have sat this bull market out, and if they had just learned that the economy is moving the opposite direction of the trend of their employment rate, they would not have. So sometimes getting back to basics is most important. So I would have first Friday of every month, 8:30 Eastern, this data is released, and you can bet that I'm in my office taking notes. Today was a release date, and I was in here taking notes at 8:30 this morning. From there, rising commodity prices. These include things like oil, include things like, I use 17 raw industrials to help me understand the commodity price behavior, and I want commodity prices to be going up because of increased demand. That's what happens off of an economic or market trough. Inventories then decline within companies, profits accelerate mid-cycle, capital expenditures increase. M&A activity also increases here. IPOs, companies come public. A lot of these things happen in a mid-cycle bull market. And then as you move up the page, you finally get to bull market killers, and there are two of them. rising interest rates by our Federal Reserve typically in order to combat rising inflation. Please understand these are how bull markets and economies end on their bull phase. They can end for other reasons. Shock to a system can end them. There are other reasons why they may end, but the typical reason, the textbook answer, is a Federal Reserve which has to come in and take the punch bowl away, which is another thing that we've sort of heard them say through time. But they are doing that in order to combat rising inflation. And finally, low unemployment is the marker at market tops. Unemployment rate was 4.6%, same as it was now. It was 4.6% in 2007. It then went to 4.8, 4.9, 5, and then finally 5.1. Whenever the unemployment rate has gone up by 0.5, in that last example, 4.6 to 5.1, or could have gone from 4.2 to 4.7, or if it troughed at 5%, it would go to 5.5. Whenever it's gone up by 0.5, an economic recession has always followed. So you can see, while it may be a lagging indicator, it's extremely accurate in its depiction of economic strength or weakness. And that's why the unemployment rate holds the boardwalk and park place of real estate on this page. And then finally, low unemployment gives way to falling commodity prices, just as high unemployment gave way to rising commodity prices. So 7 becomes 1, 8 becomes 2, 9 becomes 3. They are just, the signs are positive on the left-hand side of this page, and they are negative on the right-hand side of the page. And there you have a basic economic cycle. Please, look at these as important variables that you should look to try to figure out where we are in an economic cycle, and it will help with any business. So understanding where you are and what you should be doing, depending on where you are in an economic cycle, I think is imperative. Human emotion is now something else I wanted to put on my one-pager, and that is the outermost colored circle is how we as human beings react to an economic and market cycle. At market bottoms, at 6 o'clocks, as I shorthand them, we are fearful. It is extremely important to understand that when we are fearful as human beings, what we tend to do and everything else that causes us fear is to create distance between ourselves and the thing that might cause us pain or fear. And in the equity markets, unfortunately, that means selling the stocks that are in your portfolio. Those of you that are business owners may not have that ability, right? Your business is not as liquid, so you sometimes can't sell your business. But many times when you are that fearful, it might seem like something you wish you could do, although you probably wouldn't get a price that you thought would be warranted. So we are fearful, and in the public markets, again, we tend to let go of our stock, and a lot of times that letting go, indiscriminately letting go at any price, creates the market bottom itself. The fearful seller, therefore, the next emotion that comes as the economy begins to catch gear is they are disgusted with themselves that they sold at the bottom, but that they doubt that the rally and they doubt that the economic expansion that has just started is real. So they doubt. And so they continue to sit on cash if they're invested in the public markets. And we've seen these investors, many investors that sold out in 2009 are still not back in the markets, even as we sit at Dow 20,000 and celebrate that today, or close to that today. Wall of worry is next. It is overused on Wall Street, but I believe it is between 8:30 and 9:30. This is a wall of worry market where if you give markets bad news, they go up anyway, and if you give them good news, they go up a lot. Buying the dips at 9 o'clock in a 9 o'clock mid-cycle market will make you wealthy. It is a market which is amazingly resilient. 9 o'clock markets are a lot of fun when they come around. Greed finally kicks in. This tends to be 5 years from fear. In real time, 5 years have gone by between 6s and 10:30s. Finally, bull markets, at least those that are bubbly bull markets, end on euphoria. This is a person that pays too much for stocks, and they also pay too much for businesses. So you, as business owners, have only one decision to make. If a euphoric buyer shows up at your business, knocks on your door, and wants to take your business out at a wonderful price, you have only one thing that you can do, and that is to sell it to him. I mean, they do happen. They tend to happen late in cycles. And I've talked to many business owners who have had a euphoric buyer approach them. They turn them down, only to regret it years later as then a recession comes and things have to reset, especially as you age, right? Especially as to get around this full cycle takes about a decade. So these things happen in, think 7 to 10 year periods. So please think about the going around a wheel takes just short of a decade. And so many people who want to sell businesses have a date in mind. And sometimes the market, I always say the market will tell you when you can sell your business. You can pick a range of dates, maybe a 5-year range or something where you may want to sell your business. But sometimes picking an exact date is a fool's game, unfortunately. The euphoric buyer pays too much, and then wishing and hoping kicks in as the price of the asset falls. I always use the example, you buy a stock at 100 and it falls to 80, and you wish and hope that it will go back to 100. It doesn't. The wheel does not move backwards. So the $80 stock goes to 50 at self-loathing and misery at 20, and then fear down there at 10. And you don't have to go very far to find these types of names. Amazon.com, for example, went from 100 to 10 during the tech bubble and burst. Even Citicorp went from $50 to 1. So you don't have to go down to these names that nobody's heard of. Many stocks from euphoria to fear. When you do get a full-fledged bear market, there'll be many common names that do unfortunately go down almost the whole way. The proper mindset is in the innermost circle. The innermost circle is a proper mindset of an investor, and I would also say of a business owner to some degree, although I'll touch on that a bit later. At 6 o'clock, the proper mindset is to be a contrarian, and a contrarian, of course, means doing the opposite of what everyone else has done or what everyone else is doing. And it also means doing the opposite of what everything in your own being is telling you to do. Every fiber in your being will have you be running away from the stock market and from your business potentially, expanding your business and anything else. But the contrarian is a must kick in, and that is to do the opposite of what everyone else is doing. Very hard to do, but a contrarian has a chance to, of course, make all the money. You buy at 6 o'clock and settle 11:59, and you've made all the money. Positive bias as you climb a wall of worry. I talked about the resiliency of 9 o'clocks, and that just shows you the proper mindset is to watch the market only move higher. That is what it tends to do, and you should expect that at 9 o'clocks. As you get into a late cycle bull market, aggression is needed. You can be very aggressive in your portfolio, but you must understand that you're playing a game of hot potato, that you eventually have to become prudent. So aggression moves to prudence at market tops, and that's the prudent business owner even potentially also doing the same types of things. I'll talk about what a business owner should do at 12 as well. And prudence gives way, unfortunately, to capital preservation. The worst part of this wheel, ladies and gentlemen, is not 12 that you should fear. It is 3. If bear markets go in 2 stages, if they happen in 2 stages, most bear markets are only single stage. You can go from 12 to 3 and skip all the way to 7. But if the bear market enters the second stage, you'll see the most defensive words on the page are capital preservation. And that is where the baby gets thrown out with the bathwater in the public markets. 3 to 6s are short in time. They're 6 to 12 months in length, but markets go down between 20 and 30% in addition to what they went down between 12 and 3. When you combine 12 and 3s with 3 and 6s, you get down 50% about. And these are brutal, but as you look back historically on returns, you'll find that most of the damage is done late in the bear market cycle. But that allows the contrarian buyer to, of course, separate baby from bathwater, and again, a chance to make all the money. This is a framework that I've used, like I said, for 14 years. It helps me understand where we are in cycles, but of course, to me, it doesn't mean much if we were all sitting here and guessing where we are. So I have good news. I'm sitting in my office in Boston, and as those in the office with me can attest, it is all numbers. I work on a very quantitative, rigorous methodology, and so I have actually mapped every 6 o'clock going back 50 years with complete rigor. I've mapped every 7, every 9, every 10, every 12, and every 3. And so I therefore have kind of the historical perspective of not only guessing where we are, but having the rigor to say this is historically where we are. This is exactly what's happened before, and this is how we should be positioning portfolios today. This is a major input into our asset allocation decision-making process. a committee that I chair that meets monthly. So because I've mapped every 6, 7, 9, 10, 12, and 3, I'm also able to run any data series through this methodology. I was asked a few years ago from small business owners to say, well, when should I sell my business? What time should it be? When are multiples paid the highest for business transactions? So I went back and ran that data through my methodology. And there you'll see the gold words, sell, is in the upper left-hand side of the page. You should actually sell one's business, or let me rephrase that. The multiples paid are the highest when the public markets are at 10. So business owners, if you are thinking about selling your business anyway, and you are in the public markets which are signaling 10, understand that those multiples paid historically are the highest. I understand that all businesses are idiosyncratic. They all have individual issues with them, either higher growth, lower growth, high cash flow, low cash flow, high promise, right, or most of it's already, it's a high cash flow business, those types of things. I understand all those things are different, but I'm telling you from 30,000 feet, the multiples paid the highest are late cycle bull markets. If you do get a 12 o'clock, the business owner should be in a mode of protection, right, protecting one's business. Please do not expand, do not hire, do not take on debt. Right, you are entering an economic slowdown, which may turn into recession or not, and so protection is imperative if I were to tell you that we were at 12. If we get down into 6 and 7s, that's the time, again, thinking like a contrarian, where you must go after cheaper capital, you must take out competitors, or you must let competitors be taken out by themselves if they didn't protect as well as you did because you knew it was 12 and they didn't. So let, unfortunately, capitalism has a crueler side, let them fade away because they could not protect themselves enough, leaving fewer competitors for you. So the gold lettering is really to the business owner, what one should do. And therefore, I think this is pertinent to all people on the call about kind of not only what you should do with the money if you have any invested in markets, but how you should run your business potentially as well. So the question now becomes, well, where are we today? And that answer can come as I bring up my next page. There we go. So you can see here that we are in this forked position. A stock market sits at 9 o'clock, that beautiful wall of worry market, which I told you before, the key variable that you will hear written about in 3 months and 6 months and 9 months from now will be resiliency. This wheel has an ability to write tomorrow's headlines, and I don't mean tomorrow specifically, but I do mean tomorrow in a broader sense. 6 to 12 months from now, you will find the word resilient. You'll find a market that if you buy dips, you will be well rewarded. That is what history says about this. To a business owner, what does it say? It says that, once again, you're starting to come to a market where you may, if you are thinking about selling one's business, this isn't a bad time. It's not quite 10 o'clock yet, but it is close to that. And if you are if you can't wait another 10 years potentially, that perhaps thinking about exploring, and I know that even when you decide to sell one's business, it can take a good 1 to 2 years to actually have the transaction take place. So here's some lead time potentially for those of you that are older that are thinking about selling. And I always look at it in the IPO market. You will start to see initial public offerings. They will start to come again. They didn't for the last 16 months. We were not at this time, but you will start to see IPOs. You'll start to see animal spirits again to take over because we are in this sort of 9 o'clock market where the economy, again, a bit later. But I think the stock market will do quite well this year because we are in a wall of worry tape. And as I mentioned before, we are closing in on all-time highs. The S&P is at all-time highs. The Dow is approaching 20,000. And the NASDAQ hit an all-time high a couple of days ago. So, again, the stock market is bearing out historically. So then the next question people ask, well, what does 9 o'clock, what do they look like historically? So let me tell you, because I've done it with such rigor, and then we'll wrap up shortly. But here's what 9 o'clocks look like historically. The current phase, we entered 9 o'clock. This time happened on November 30th of last year. So we've been in it for about just over a month. But let me show you how long 9 o'clocks last. The left-hand side of this page talks about how they last a minimum of 1 month historically, or a maximum of 41 months. So a wonderful time. 9 o'clock, these are not fast. These take time to play out. The average length of time, 18 months. cumulative market performance, this is the S&P 500. A minimum return, 9 o'clocks, is down 1%. Maximum is up 38. If you average all the 9 o'clocks together, they average 15.4% positive return on the S&P 500. Market cap, you can see it favors small cap over large, 24.9 versus 20.3. This is the upper right-hand side of the page. The current time, it's only a month old, but again, small caps are also leading large this time around, as I showed you in the first chart. And also favors value over growth. So those of you that are in value industries, in the public markets, they're finance and energy. They tend to cluster in those areas. Or you can see the outperformance of value over growth historically. And this time around, again, very early days, but the current market's also rewarding value stocks over growth since this signal began on 11/30 of 2016. So again, it's one of the other reasons why I stand sort of in a bullish, cautiously but a bullish mode as we sit here today. Finally, our last page is a summary of if you were a client of ours, this is what your allocation would look like. Whatever your neutrality is, and that would be based upon your risk tolerance and goals for your money, objectives for your money. But here are internally known as our diamond chart. This shows you how it would positioning your portfolio. An overweight to equities over bonds, an overweight home field advantage, an overweight to domestic over international, and within domestic, again, an overweight to small and mid-cap stocks over large. Our only significant underweight is in the emerging markets area, and I talked about that on the first chart. We are underweight fixed income. These are interest rate exposure, especially in treasuries. We do like, if you do own bonds, please put some yield in your bond portfolio, either through corporate bonds, even some high-yield debt and tax-exempt debt as well. Finally, diversifiers. These are asset class which buffers a portfolio from the bouts of volatility that I talked about. These are low correlated assets. We particularly like absolute return vehicles and managed futures because of their low correlation to other asset classes, including fixed income and equities. So that in general is a quick overview of my views. Again, not only what we are thinking, but much more importantly that you should ask any advisor, why are you thinking that? What rigor do you have? Because I will tell you, talk is cheap. I've been on CNBC over 100 times, and the price of admission for getting on TV is how the market will trade for the next 90 minutes. We think very short term, and I think a lot of money is lost, unfortunately, because of our short-term thinking. Must have a wonderful methodology, and then sort of the rigor and the discipline and the fortitude to apply it. I think that is how success is. It eventually comes to those who follow those rules of the game. I think you increase your odds substantially. Why don't I stop there, and I'm going to turn it back to Bill, and I think we are going to go to some Q&A.
Jeff, that was fantastic. I've written at least 2 pages of notes. I'm sure listeners have as well. We have several questions to get to. The first I would say is, do you have advice for a new business owner given where we are in the cycle?
Ignore it for a while. There's really nothing, right? You are going to play out. You have to build your business. You have to, you still have to understand where you are in that cycle. But most business owners utilize this wheel in order to find points of exit from their business. A new business owner must understand kind of where we are, but they have to go out and get revenue and hire employees. And I'd wait for 12s. I would continue to touch base with us. I speak for Vistage around the country, so it is important to kind of know where one is in the cycle itself. But to grow one's business, it doesn't sort of matter what time it is. And to go out and get your first clients and build a brand and all those things are going to be regardless of what time it is. It might be easier to do it certain times rather than others. So I don't think the word ignore is quite proper, but you have to stick to your knitting and really build your own business knowing that you're going through cycles, but knowing that you're going to have to weather them as well. Have enough capital to do so, right? Prepare for the rainy day. When 12 o'clock comes, prepare in advance. What will you do? And when 6s and 7s, if it were that time, what would you be doing? So I think you always have to think, strategically. And know where your business is. Think about this, that every business is somewhere on the wheel all the time. And some businesses, just like some companies, even though the general market is at 9, your business might be a leader of economic trends or a follower. Those businesses that, for example, sell to municipalities are lagging because municipalities are based on tax revenue, which is based upon last year. So they're behind the wheel, where other firms are, can be on the cutting edge of the wheel itself. So what industry you're in is also quite important.
Excellent insights. Are there any specific risks that you're monitoring that would change your view of where we are in the economic cycle?
So right now, as I told you about, we are looking, inflation and interest rates right now are on my radar screen. There are, of course, many others, geopolitical issues, protectionism, all these other things that I'm looking to. But the textbook answer will be unemployment will continue to be fairly strong, as we saw today. And now it's about wage push and wage pressure and the velocity of money also. So look for bank. That's the shorthand way of talking about bank lending. And bank lending policies, bank lending standards should also become weaker or more. They'll be more apt to lend. So if you're a business owner and have had trouble getting capital, those markets may begin to free up for you a bit. You may find it easier, might higher interest rates, of course, but a bank that is more willing to take a chance. But I'll look for that to happen in the extreme, right? I'm going to look for higher inflation, and that'll come again through wages and velocity of money. So those are the two main factors that I'm looking at now, just like the wheel would tell me to do, right? Because we're at that stage where those are the variables economically which are the most important.
Thank you. How will Trump's presidency impact the economy, and specifically what policies do you see him trying to implement most aggressively?
So the Trump presidency is an interesting one. There's certainly some policies which are very favorable for economic growth, including, again, historically, when Reagan and Kennedy put through tax cuts, you had a very strong economic growth, as I mentioned earlier in the call. So let's look to see what happens there. Let's look to see what happens on the regulatory issues. Okay, let's look to see if more small businesses can be formed, because we've been on the downtrend for the last couple of years on small business formation from some of the data that I've seen. So, to me, the two biggies are regulatory and tax. Lastly, again, as I mentioned, the infrastructure bill is also a positive, but might have a significant lag in it. But those would be the three that sort of sit on the plus side to me as far as economic growth. And the negative would be protectionism. Although it sort of sounds good in theory to bring jobs home and, tweet about companies kind of shaming them into staying and not moving to Mexico or wherever the case may be, or charging too much for Air Force One and all these other things that he has done, those can be detrimental. I learned in business school and undergraduate, again, that the best way is to have free markets, free and fair markets. So perhaps renegotiating trade agreements is a good thing if it puts the United States in a better position. But protectionism, you will see that the stock market will not like that. It will see it as a closing off, and it lowers economic global GDP. So these are the things that we'll have to monitor as a strategist. To me, that may be a potential negative, and even talking about it could also have negative repercussions. The worst thing we want, in my opinion, would be a trade war, a protectionist trade war, those types of things, which can have negative ramifications economically, not just in the U.S., but globally. So he's sort of 3-to-1. He's got a lot of positive. That's why you're seeing the markets doing what they do. But we'll have to watch him on sort of protectionism and other things, other tweets which he may come out with in the months ahead.
Very good. Thank you. What's your outlook on oil and natural gas pricing?
So we do not sort of make oil predictions, but I would talk about oil stabilization. I think that is, in fact, was one of our major themes for 2016. And I think that will continue into 2017. Oil and natural gas, they will tend to, especially oil, will tend to settle at or near a price which equals its cost of production. And I wrote long ago that the cost of production was between $50 and $70 a barrel. I wrote that in 2016. And here you see us right now hovering in the low 50s for oil. I think as more technology comes online and fracking and all these other things, that our cost of production has declined, and that might allow oil to find a steady state, a bit lower. But I think around this price is probably a fair long-term view on oil. There are some strategists that I've talked to which talked about we will be much more volatile in the price of oil because there is no longer sort of a strong OPEC which can control price, so you may see it more susceptible to violent price swings, both up and down. But I think in general, again, using that rule of thumb that it long-term equals the price of production, I think is a good starting point. As far as natural gas, again, I think the same thing comes to fruition. We are loaded with natural gas in this country, and perhaps as we look to liquefy and ship it out, export, those types of things, might put some upward pressure on natural gas if there is greater demand for U.S. natural gas globally. But again, I think because it is so cheap here to produce, I don't see it. Again, I don't think price is going to spike a lot higher in the near future. But I think the worst of these markets that happened in 2014 and in 2015 are over, and I think more of a stabilization and equalization is happening in the near term.
Excellent. Hey, Jeff, could you back the slide back to the wheel while we're going through questions? We had a request for that so people could take a better look at that. And I had a question on the wheel. On the clock, one listener said, I think you showed the stock market at 9 o'clock and the economy at 10 o'clock, which you did. If the stock market's a leading indicator, is this generally what the times on the clock are telling me?
The stock market is a leading indicator, so let's get that out there right now. Most of the time, the stock market is leading the economy. However, there are some points on the wheel where the opposite takes place. You can see that my very sexy title was the interaction between the economy and the stock market. You can tell that I'm an economic and finance background, and I'm not in marketing. But the interaction between the two, please understand that the stock market is a leading indicator all in and of itself. The stock market is a predictor of its own returns, believe it or not. And it clearly is also a leader of the economy. However, there are some times on the wheel where the economy questions the stock market's strength. And that's what it has done recently. And when it does that, it pulls back. And in doing so, you'll see the economy sort of sits there and says, no, I'm still okay. But the stock market questions it. The joke about the stock market is it is famous for predicting 3 of the last 10, I'm sorry, it's talking too much. The joke about the stock market is it is famous for predicting 10 of the last 3 recessions. So that should tell you again that the stock market shoots first and asks questions later. And when it does that, it drops below the economy by this view on this wheel. Again, it's 30 years of work on one page, so it's not perfect. As far as sometimes, because it's a wonderful question, it's a very insightful question, and I'm here to tell you that by this stock market being below the economy, I do not think that the economy is the leading indicator. The stock market trails it. Most of the time, the stock market is ahead. There are just occasions, and this is one of them, in which the stock market questioning the economy's strength puts it by this process and philosophy. It puts it behind the economy. That the economy sits there and says, see, I told you I'm right, and the stock market has to go up, which it's doing, in order to catch back up with where the economy is, which is in a late cycle. I hope that answers the question. It's a wonderful one.
That's great. Yeah, that is very clarifying. And I think one of the questions that's come in is, do you have any thoughts on how long it will be before the stock market reaches 12 o'clock?
So on that following page, I gave you the history of nines that I've flipped to now. So you can see that the average length of time that nines last are a year and a half. So 9 o'clocks end in one of 2 ways, only one of 2 ways. They go to 10, in which you get another gear to a stock market, and right owner should sell, and all those types of things might happen. But 9 o'clocks also can end at 12. So you have to be cognizant that this 9 o'clock could end with recession, in which I believe that it will. And if you ask me to predict when our next recession would start, it would be 18 months from now, right? So that would be my average, right? But I get to watch the economy. I get to watch all these things take place in real time, and we may change our opinions for our clients before that or after that, or might go to 10, in which I would change my mind again. But if you ask me today, sitting here in early January of 17, I would say yes, we'll have a recession, and it will happen in mid-2018, late 2018, something. Who knows? A person that would tell you that with great certainty is a liar. What I've learned from doing this for 30 years is that, it pays to be humble, but it pays to have rigor, but it pays to be humble as well, that I don't know. You can see the range. We could be in recession right now based upon this because it's 1 month, or it could be 41 months from now and then go to 10 o'clock, and you could have a bull market that continues for 5 or 6 years is also possible. All those things are in the probability set. But if you ask me right today, from talking to my economists and others in the industry, again, utilizing the wheel as my framework, I would say that we enter recession late 2018 because of higher inflation, and the Fed has to increase interest rates enough to drive us to recession. That to me is the path of least resistance.
Excellent. For our listeners, I want to let you know that you can get a link to the slides in the chat panel, and you can also check on the Fridays with Vistage website page sometime next week. The links will be up there as well. Hey, Jeff, one of the trends that seems to be happening is the percentage of electric cars that are being sold. Is this minor or significant for the future?
It doesn't enter into my world. Paradigm shifts take place all the time. Solar panels, moving from horse and buggies to cars. I mean, these radio, internet, right? These things transpire. If you're asking, sort of, is that the next trend? Is that somewhere on the wheel? The wheel flies so high, much higher above that. That, to me, if you're in that business or supply to that business, I mean, it's an interesting trend that's transpiring, and it probably has very little to do with the wheel itself. It may have more to do with the price of oil, right? These are, when the price of oil rises, electric, and we as human beings, we substitute away from high commodity prices. So that's what we do. We're very good at that. We're very, we adapt. If oil stays low, stays at 50, 40, and hovers there for a long period of time, you can see what we do is we go out and we buy SUVs. So, I think a lot of these trends are much more dependent sometimes on an individual variable, not the overall economy, not overall interest rates, not a lot of these other things that drive our overall economy, but instead a single variable which drives that one. So that to me, and again, if you're in that business, and you have to pay attention not necessarily to what time it is, but determine what variables matter to your business, and put them somewhere in the economic cycle. Put your own business on the economic cycle. Understand sort of where you fit. Who buys from you? Who do you sell, right? Who do you sell to? All these other things. The best money managers I know, money managers, these people that run money in the public markets, they understand who they buy from and who they sell to. They understand where they sit on the wheel. They understand the role that they play in the capital markets. I think every business owner should also understand what variables hurt them, help them, and how they must adjust depending on what that outside variable that they cannot control is doing.
Thank you, Jeff. We just have time for a couple more questions. One of them is based on debt. About how much debt does our country really have from a non-politician's point of view, and how does that impact decisions in the economy moving forward?
I get that question a lot. Certainly, if you were afraid of national debt, you would have been out of the stock market since Obama began his presidency. You would also be out of the stock market when Reagan began because he took on a lot of debt as well. I think so. It's important to understand kind of debt, but also put it in perspective. I look at debt as the percentage of GDP. I look at especially non-government owned debt, right? That's what you really have to focus on. That's about 75% of our GDP. So it's certainly there's been some research done that it starts to impact economic growth at about 100% of GDP. So we sit below that level. There are other countries, Japan, 250% of GDP, right? So there are other countries that have significantly higher debt, most of it owned by their own citizens, at least in Japan. So it's something that I'm mindful of, but the debt that we have and the fact that rates may rise and make our debt more expensive, there's a couple ways to get out of debt. One is to, of course, to pay it down, and the other is to grow yourself out of it. And we'll have to see what debt Trump takes on, whether or not it's building bridges to nowhere or whether it's actually good infrastructure build. Just like anything else, if you take on debt and then make a good investment with it, it can pay off. If you take the money and build bridges to nowhere, it won't. And so I think it's not only the debt, but the quality of the projects that come out of the debt that is taken on. So let's look at that too. You can include, a lot of people include student debt and all these other things. There is a lot of debt, And I think the best way out is to grow oneself out. We'll have to see sort of how that transpires. But it, to this point, is not impacting our asset allocation decisions. Might it down the road? Certainly. So I'm mindful of it. I'm not brushing it under the rug. I'm just telling you that as of now, it's not impacting our decision-making process. But in the future, it might if it becomes too high. Yep.
Okay, that's great. Hey, Jeff, one of our listeners wants to know, do you have a Twitter account that where you post? We're tired of seeing Trump's. We'd rather see yours.
Yeah.
Serious question, do you?
Yes. BNY Mellon Wealth Management does have a Twitter account, but then they tweet on my behalf occasionally. But okay. I stay off that stuff. It only gets one in trouble.
Okay. Let's
Trump
wrap
maybe
it up
should follow the same advice.
Let's wrap it up with a quick discussion on something that's on a lot of people's minds right now, and that's the rising minimum wage and the impact that that'll have on employment, inflation, the U.S. economy, robotics, all the changes that are going on with that. What's your take on that?
So certainly, again, late cycle bull markets, where the economy is, as we sit here today in early January, puts upward pressure on rates because on inflation, because it puts upward pressure on wages. So the wheel is telling you that this is a part of the cycle where that happens. Minimum wage, to me, is a symptom of that, right? It is an output of that belief. So you're seeing all those things come to fruition. And to me, it's now very important that we monitor wage growth, because once wages get too high, they put incredible pressure on companies in general, and it makes it harder for them to find workers, and it also makes the Federal Reserve, it's also inflationary, and it causes the Fed to raise interest rates aggressively, therefore putting an end to an economic cycle. So I'm watching them very carefully. Robotics, of course, all those things can put downward pressure on wages to some degree. Productivity puts downward pressure on wages. Productivity has been poor over the last few years for some reason. Economists are still trying to figure all that stuff out. So to me, these are all symptoms of a late stage economic cycle that we all have to be aware of. If you are business owners, this is the time where you are going to have to pay more to attract and keep talent. That's just, we are in that part of the cycle. That, like I said, it will eventually end. You'll get some relief from that as economic downturn takes place, and then it'll reset itself down at 7, and it'll be more equal strength employer and employee. But right now, I think you're really moved from employer strength, which we've had for a number of years, and now we're probably going to move to employee strength. And again, you're seeing that in various outlets that you mentioned in the question. I think that, again, is just a symptom of where we are on the wheel. And like I said, it will eventually end, but it will end when we go into recession in this country.
Jeff Mortimer, I want to thank you so much for a very, very informative, wonderful presentation. I want to remind our listeners that you can access the recording sometime next week on the Fridays with Vistage webinar. Jeff, thank you so much for a wonderful presentation.
It was my pleasure, Bill. Look forward to doing it again. And again, I travel the country and speak at many Vistage cities. I've done Utah, Los Angeles, Chicago. So I look forward to meeting a lot of you in person if that happens down the line. And I appreciate the chance to speak to so many of you in such an efficient and effective way.
Excellent. And I want to remind our listeners to access the Fridays with Vistage page on the Vistage website for news about upcoming webinars, and take a look at some of the archives. There are some wonderful webinars that have been done in the past several months that are available for you there. I want to thank you all for joining us today. And on behalf of Vistage International, this is Bill Black wishing you continued success.